Friends, thank you for being here today. What if I told you that your pension, the money you've been counting on for retirement, is no longer buying safe government bonds? What if I told you it's now funding risky loans to companies that banks refuse to touch? This isn't speculation. This is happening right now. The Canada Pension Plan Investment Board has made a dramatic shift. They've moved billions of your retirement dollars into something called private credit. They call it diversification. I call it something else entirely. I call it a casino bet with your future. Let me give you a number that should make you uncomfortable. Between 40 and 45% of the CPP portfolio is now in private equity and credit investments. That's nearly half of a fund that's supposed to be conservative, half of a fund that's supposed to protect Canadian retirements. Compare that to real estate, which used to be a cornerstone of their strategy. It's been slashed to around 8%. They're running from office towers, they're running from commercial property, and they're running straight into the arms of the riskiest lending market in modern finance. This is a structural fault line, and when it breaks, millions of Canadians will feel it. Now, you might be asking yourself, why would they do this? Why would a pension fund abandon safety for risk? The answer is discipline, or rather the lack of it. They need yield. Traditional government bonds are paying around 4%. That's not enough to cover their obligations. That's not enough to hide the losses they've already taken. So they're chasing 10 to 12% returns in private credit. They're stepping into the shadows. Let me be very clear about what private credit is. It's lending money directly to companies, not through a bank, not through regulated channels, direct loans, often to companies that can't get financing anywhere else. There's a reason banks won't lend to these companies. There's a reason regulated institutions are staying away, and your pension fund is walking straight into that gap. Think of it this way. Imagine you have a neighbor who needs to borrow money. He goes to the bank. The bank looks at his finances and says, no, too risky. Then he comes to you, and you say yes. You lend him the money at a higher interest rate because you need the income. That's what the CPP is doing, except the neighbor isn't a person. It's a struggling corporation, and the amount isn't a few $1,000s. It's billions. This leads us to the system's most crucial secret, which we will explore later. But first, we need to understand how we got here, because this didn't start yesterday. This is the final act of a long tragedy. Let's go back, not to last year, not to the pandemic. Let's go back to the foundation. The Canada Pension Plan was designed in the 1960s as a safety net. It was meant to be boring. It was meant to be stable. For decades, it bought government bonds. It bought blue chip stocks. It invested in infrastructure, safe, predictable, boring. Then something changed. In the 1990s, pension funds around the world discovered a new strategy. They started chasing higher returns by moving into alternative assets, private equity, real estate, hedge funds. The CPP followed this trend. And for a while, it worked. Real estate boomed. Office towers in Toronto and Vancouver became cash machines. Private equity deals delivered double-digit returns. The CPP grew. It became one of the most respected pension funds in the world. But every boom plants the seeds of its own destruction. The office tower bets started to crack. Work from home became permanent. Companies stopped renewing leases. Buildings that were valued at billions were suddenly worth fractions of that. The CPP held massive positions in these towers, and they couldn't sell them without taking catastrophic losses. So they had a choice. They could mark down the real estate portfolio honestly and show Canadians the truth. Or they could hide the losses by generating high cash flow from other investments. They chose the latter. Enter private credit. Here's how the mechanism works. When you own an office tower that's losing money, you have a problem. It shows up on your balance sheet as a loss. But if you can generate high interest income from lending operations, you can offset that loss on paper. You can show positive cash flow even while your capital is being destroyed. It's like having a mortgage at 0%. You borrow cheap. You lend expensive. You pocket the difference. Except the CPP isn't borrowing at 0% anymore. And the companies they're lending to aren't safe. Think of it like a mortgage at 0%. But the house you're buying is on fire. Now, the government plays by different rules than you or I. They can print money. They can change regulations. They can make promises that span decades. A pension obligation is essentially a 200-page IOU written to itself. It's a promise to pay Canadians in the future using money collected from Canadians today. But what happens when the investments backing that promise turn toxic? This is where it gets dangerous. The CPP isn't just buying private credit randomly. They're doing it in partnership with the biggest players in finance. Blackstone, Apollo, KKR. These are the giants of private equity, and they need something from the CPP. They need exit liquidity. Let me explain how this relationship works. Private equity firms raise money from investors. They use that money to buy companies. They load those companies with debt. They cut costs. They try to increase profits. Then they sell the company for more than they paid. That's the model: buy, leverage, sell. But what happens when no one wants to buy? What happens when the company isn't performing well enough to sell at a profit? What happens when the market turns cold? The private equity firm needs a solution. And that solution is often refinancing. They go back to the debt markets. They borrow more money. They use it to pay themselves dividends. They kick the can down the road. And who's providing that new debt? Who's willing to lend when banks won't? Pension funds, funds like the CPP. This is the handshake. The private equity firms get their liquidity. They get to book their profits. They get to tell their investors that the deal was a success. And the pension fund gets a high yield loan. Except here's the problem. That loan is only high yield if the company survives. If the company fails, the pension fund becomes the owner. They have to seize the assets, they have to run the business, or they have to liquidate it at a loss. Does the CPP want to run a failing auto parts manufacturer? Does it want to manage a struggling retail chain? Of course not. But they might own several soon. This is what I call the big secret of the entire system. The pension fund isn't investing for returns anymore. It's providing life support to zombie companies so that private equity firms can exit their positions. You are the exit liquidity. Now let's talk about the evidence, because this isn't theory. This is already happening in real time. The CPP has been quietly dumping office towers. They're selling at losses, they're taking write-downs, and they're hoping you won't notice. Let me give you specifics. The CPP sold stakes in Vancouver office towers, properties on Dunsmore Street, properties on West Georgia Street. These were flagship buildings, prime locations, and they sold them at significant discounts to their previous valuations. In Toronto, they unloaded 2 Queen Street East, another marquee property, another loss. These aren't small adjustments. These are fire sales. And they're happening while the CPP tells Canadians that everything is fine. But here's what they're not telling you. They haven't marked down the full extent of their office portfolio losses. Not yet. They're doing it gradually, quietly, hoping the problem will solve itself. It won't. The office market isn't recovering. Vacancy rates in downtown Toronto are at record highs. Companies are giving up space. Leases are expiring and not being renewed. The structural demand for office space has permanently changed. So the CPP has a balance sheet problem. They own assets that are worth far less than what they paid, and they can't sell them all at once without triggering a panic. This is where private credit becomes the solution, not an investment strategy. A cover-up strategy. By generating high interest income from risky loans, they can show positive cash flow. They can tell pensioners that the fund is healthy. They can mask the capital destruction happening in the real estate book. It's financial engineering, and it's dangerous. Let me walk you through what private credit actually is, because the term sounds sophisticated. It sounds like something safe and professional. It's not. Private credit is the unregulated lending sector. It's what happens when banks pull back, when traditional financial institutions tighten their standards, when regulated lenders say no. In Canada, the banks are under pressure. The Office of the Superintendent of Financial Institutions, OSFI, has imposed stricter capital requirements. Banks need bigger buffers. They need more reserves. They can't lend as freely as they once did. So who fills the gap? Shadow banks, pension funds, asset managers, anyone willing to take the risk that regulated institutions won't. The CPP is now one of those shadow lenders. They're stepping into deals that RBC won't touch, that TD won't finance, that Scotiabank has rejected. Think about that for a moment. The institutions whose job it is to assess credit risk have said no, and your pension fund has said yes. Why would they do this? Because they need the yield, because they're desperate, because the alternative is admitting that their previous strategy failed. Now the CPP will tell you this is about diversification. They'll say they're spreading risk across different asset classes. They'll use words like sophisticated and institutional grade and due diligence. Don't believe it. This is about chasing returns in a zero-sum game. And in every zero-sum game, someone has to lose. The question is who? Let me tell you about illiquidity, because this is the trap that's being set right now. When you own a government bond, you can sell it tomorrow. There's a market. There's liquidity. If you need cash, you can get it. When you own a stock, same thing. You can sell it within seconds. The market is open. Buyers are waiting. But when you own a private credit loan, you're stuck. There's no exchange. There's no market maker. You can't just press a button and sell. You hold that loan until it matures or until the borrower defaults, whichever comes first. This is what's called an illiquidity premium. You get paid extra because you're trapped. The CPP is getting 10 to 12% yields, but they can't exit if things go wrong, and things are going wrong. Let me give you a canary in the coal mine. Not from Canada, from the United States, but the lesson applies. There was a company called Tricolor. It was a subprime auto lender. It specialized in loans to people with bad credit, high risk, high yield. Exactly the kind of business that private credit funds love. Tricolor collapsed when credit lines froze, when liquidity dried up, when the loans started defaulting faster than expected. The lenders who backed Tricolor were left holding worthless paper. They couldn't sell the loans. They couldn't recover their capital. They had to write it all off. That's the risk the CPP is taking, multiplied across dozens of companies, across billions of dollars. Now, you might be thinking, surely they're being careful, surely they're doing their homework, surely they're only lending to solid companies. Let me tell you why that logic doesn't hold. The companies that can get bank loans don't need private credit. They go to RBC, they go to TD, they get financing at lower rates, they stay in the regulated system. The companies that come to private credit lenders are the ones the banks rejected. They're the ones with weak balance sheets, with declining revenues, with uncertain futures. There's a reason they're paying 10 to 12% interest, because the risk of default is high, and your pension fund is the one taking that risk. Now let's talk about what happens in a recession, because we're not talking about if anymore, we're talking about when. When the economy contracts, these marginal companies fail first. They can't service their debt. They can't make payroll. They go bankrupt. In a normal loan, the bank takes a loss. But the bank has diversified. The bank has reserves. The bank has thousands of loans. One failure doesn't sink the institution. But when a pension fund is a direct lender, the math changes. The CPP doesn't have thousands of these loans. It has dozens, maybe hundreds. And if 20% of them default, the impact is massive. Here's the nightmare scenario. It's 2026. A recession hits. Corporate revenues fall. Defaults spike. The private credit portfolio starts bleeding. The CPP needs to raise cash. They need liquidity to pay pensioners, but they can't sell these loans. There's no market, no buyers. They're frozen. So what do? They seize the collateral. They take ownership of the companies. Now, the CPP owns a struggling logistics company in Ohio, a failing retail chain in Texas, a distressed manufacturing plant in Michigan. Do they know how to run these businesses? No. Do they want to? No. Can they sell them quickly? No. They're stuck, trapped in a liquidity mismatch. They owe pensioners monthly payments, liquid obligations, but they own assets that can't be sold, illiquid holdings. This is the architectural flaw in the entire structure, and it's vanishing in real time. Let me give you another example. Another company, another warning sign. First Brands Group, a private equity-backed consumer goods company loaded with debt, refinanced multiple times, kept alive by successive rounds of private credit. The company finally collapsed. The lenders lost everything. The private equity sponsor walked away. They'd already taken their fees. They'd already paid themselves dividends. Who was left holding the bag? The credit investors, the shadow lenders, the pension funds. This pattern is repeating across the market. Private equity firms are using private credit as a way to extend the life of dying companies. They're buying time. They're extracting fees. And they're leaving pension funds with the wreckage. Renovo Homes. Another example. A home builder backed by private equity, financed by private credit, collapsed when the housing market softened. The equity investors lost their stake, but the credit investors lost more because they were told the loans were secured. They were told they had first claim on assets. But when a company goes bankrupt, those assets are worth pennies on the dollar. The security was an illusion. This is what the CPP is walking into with your money, with your retirement. Now let's talk about the relationship between the CPP and the private equity giants, because this isn't arm's length investing. This is partnership. The CPP is a limited partner in funds run by Blackstone, by Apollo, by KKR. They invest billions alongside these firms. They sit on advisory boards. They have relationships. And here's where the conflict emerges. When a private equity firm needs to exit a deal, they have options. They can sell to another company. They can take it public, or they can refinance. Refinancing means borrowing more money, paying themselves a dividend, and leaving the company with more debt than before. Who provides that refinancing? Often it's the same pension funds that are already invested in the private equity fund. It's a circular relationship. The CPP invests in Blackstone's equity fund. Blackstone buys a company. The company struggles. Blackstone needs an exit. The CPP's credit team steps in and provides a loan. Blackstone books a profit. The CPP holds a risky loan, and the Canadian pensioner is on the hook. This is what I mean by exit liquidity. The CPP is providing the exit for private equity firms. They're the buyer of last resort, and they're doing it with money that's supposed to be safe. Now you might ask, isn't there oversight? Isn't there regulation? Doesn't someone check this? The answer is complicated. The CPP Investment Board operates at arm's length from the government. It has independence. It makes its own investment decisions. There's a board of directors. There are quarterly reports. There are annual meetings, but the level of transparency is limited. Private credit investments don't trade on public markets. They don't have daily prices. The CPP values them internally, using their own models, their own assumptions. This is called mark to model, not mark to market, because there is no market. If the CPP says a loan is worth 100 cents on the dollar, that's what goes on the books, even if no one else would pay 50 cents for it. This is how losses get hidden. This is how problems get buried until they can't be buried anymore. The liquidity tide is going out, and we are about to find out who is swimming naked. We are facing a convergence, three distinct forces hitting at once, and each one amplifies the others. Force one, the structural break in commercial real estate, office towers bleeding value, the CPP trapped in assets it can't sell without triggering panic, write-downs happening slowly, losses mounting quietly. Force two, the domestic liquidity crisis, banks tightening standards, OSFI demanding bigger buffers, credit flowing to fewer borrowers, the regulated system pulling back, and pension funds stepping forward to fill the void. Force three, the private equity bubble, zombie companies kept alive by successive refinancings, deals that should have failed years ago still breathing, private credit as life support, and pension funds as the providers of that oxygen. These three forces are not separate. They are linked. They feed on each other, and they are all pointing toward the same outcome, a reckoning. Now, let me talk about something that has nothing to do with balance sheets, something that has everything to do with why most people won't see this coming. Normalcy bias. Human beings are hardwired to believe tomorrow will look like yesterday. We assume continuity. We assume stability. We assume that the systems we've trusted for decades will continue to function. Your pension statement arrives every year. It shows a number. That number goes up. You feel secure. You believe the system works. But that number is not reality. It's a projection. It's based on assumptions about future returns, about market performance, about the value of assets that can't be easily sold. The CPP assumes it will earn a certain return every year. They need that return to meet their obligations. If they don't earn it, the fund becomes underfunded. And if the fund becomes underfunded, someone has to make up the difference. That someone is you, either through higher contributions or through reduced benefits or through a combination of both. But here's what they're not telling you. The return assumptions are already aggressive. They're assuming 7% nominal returns over the long term in an environment where government bonds pay 4%, where stocks are expensive, where real estate is falling. How do they plan to earn 7%? By taking more risk, by moving into private credit, by lending to companies that banks won't touch. They're not increasing returns through skill. They're increasing them through leverage, through illiquidity, through hoping nothing goes wrong. This is the money illusion at work. You become a millionaire on paper, but poorer at the grocery store. Your pension statement says you have $1 million, but that million is invested in loans you can't sell, to companies you don't know, in industries you don't understand. And when those companies start failing, that million becomes 800,000, then 600,000, then 400,000, but you won't know it immediately because private credit doesn't have daily prices. The CPP will keep marking the loans at full value until they can't anymore. By the time you see the loss on your statement, it will have already happened months earlier, maybe years earlier. This is a default in all but name. Now let's talk about what you can do, because this is not a conspiracy. This is a stated policy. The CPP publishes its asset allocation. They disclose their shift into private credit. They talk about it in annual reports. The information is available, but it's buried in hundreds of pages of documents, written in technical language designed to be boring. They're not hiding it. They're just not making it easy to find. So here's the binary choice you face. Do you own assets or do you own claims on assets? A claim on an asset is a promise. It's a pension statement that says you're entitled to future payments. It's a stock certificate that gives you ownership of a fraction of a company. It's a bond that promises to pay you back. But a claim is only as good as the entity making the promise. If the CPP can't deliver on its promises, your claim becomes worthless. If the company goes bankrupt, your stock goes to zero. If the borrower defaults, your bond becomes paper. An asset, on the other hand, is real. It's physical. It's something you can hold, something that exists independent of any institution's promise. Gold is an asset. Silver is an asset. Land is an asset. These things have value because of what they are, not because someone promised to pay you. Now, I'm not telling you to sell everything and buy gold bars. I'm not giving financial advice. I'm giving you a framework for thinking about risk. If you believe the system is stable, if you believe institutions will honor their promises, if you believe the CPP will deliver on its obligations, then you don't need to change anything. But if you have doubts, if you see the cracks I'm describing, if you understand the structural fault lines, then you need to ask yourself a question. What percentage of my wealth is in claims versus assets? Most Canadians have almost everything in claims. Their pension is a claim. Their savings account is a claim on the bank. Their investment portfolio is claims on companies. Very few people own physical assets outside their home. Very few have hedged against the possibility that the claims might not be honored. This is not about pessimism. This is about preparation. This is about understanding that systems can fail, that promises can be broken, that the unthinkable can happen. Let me give you a historical parallel. In the 1970s, pension funds in the United States were heavily invested in bonds. They assumed bonds were safe. They assumed inflation would stay low. Then inflation exploded. Bond prices collapsed. Pension funds that had been fully funded suddenly had massive shortfalls. Benefits had to be cut. Promises had to be broken. The pensioners didn't see it coming. They trusted the system. They believed their statements, and they got hurt. Today, we're facing a different kind of crisis, not inflation destroying bond values, but illiquidity destroying credit values. The mechanism is different, but the outcome could be similar. The pension funds that look healthy today could look very different in 3 years, in 5 years, when the private credit defaults start rolling in, when the illiquidity trap closes. And here's the thing about illiquidity traps. They happen fast. One day, everything seems fine. The next day, everyone wants liquidity at the same time, and there isn't enough to go around. We saw it in 2008 with mortgage-backed securities, instruments that were rated 808, that were supposed to be safe, that suddenly couldn't be sold at any price. The pension funds that owned those securities took massive losses. Some never recovered. Private credit is this generation's mortgage-backed securities. It's the asset class that looks safe until it isn't, that promises high returns until it delivers high losses. And your pension fund is loading up on it right now in real time. So what's the solution? What's the alternative? Gold, silver, physical precious metals, not as an investment, not as a speculation, but as insurance. You don't buy fire insurance because you think your house will burn down. You buy it in case it does. You buy it for the protection, for the peace of mind. Gold is fire insurance for your financial life. It's an asset that doesn't depend on anyone's promise. It's not a claim on a government or a corporation or a pension fund. It's just gold. And it's been valuable for 5,000 years through every financial crisis, through every currency collapse, through every system failure. I'm not saying put everything in gold. I'm saying have some, have enough that if the claims fail, you still have assets. This is not about getting rich. This is about not getting poor. This is about stepping out of the line of fire, because the fire is coming. The private credit bubble is inflating right now. It's being inflated by pension funds desperate for yield, by private equity firms desperate for exits, by a system desperate to keep zombie companies alive. And when it pops, the losses won't be borne by the institutions. They'll be borne by the pensioners, by the Canadians who trusted the system, who believed their statements, who thought their retirement was safe. The simple logic that applies to you and me does not apply to pension funds. They can hide losses for years. They can mark assets at fantasy values. They can tell you everything is fine while the foundation crumbles beneath them. This is not a conspiracy. This is how the system works. This is the architecture. This is the design. And it's breaking right now in slow motion. The question is not whether it will break. The question is when and whether you'll be prepared. History favors the prepared, and the window for preparation is closing. The CPP has made its choice. They've chosen to chase yield in private credit. They've chosen to partner with private equity. They've chosen to become a shadow bank. You don't get to choose what the CPP does with its portfolio, but you do get to choose what you do with yours. You can keep all your wealth in claims, in promises, in statements that show numbers going up, and hope that the system holds together, or you can own some assets, some real things, some insurance against the possibility that the promises won't be kept. I know what I would choose. I know what anyone who understands this convergence would choose. The office towers are rotting, the banks are pulling back, the private equity bubble is expanding, and your pension fund is caught in the middle of all three. This is mathematical reality. This is structural inevitability. This is not something you can vote away or hope away. The scaffolding is cracking, the foundation is shifting, the edifice is unstable. And when it falls, it won't fall gently. It will implode. It will vaporize wealth. It will leave millions of Canadians asking how they didn't see it coming. but you're seeing it now. You're hearing the warning. You're being given the information that most people will never take the time to understand. What you do with that information is up to you. The linchpin is already loose. The fault lines are already visible. The end game has already begun. Friends, thank you for being here today. Thank you for listening. Thank you for thinking critically about systems that most people take for granted. The choice is yours. The window is open, but it won't stay open forever. History favors the prepared, and the window for preparation is closing. Is